All right. Thank you everyone for joining today and welcome to our third webinar series in our Spring Student Loan Webinar Series hosted by the DC Office of the Attorney General and the DC Department of Insurance, Securities, and Banking. This is a four-part series, and today we're talking about changes to the Public Service Loan Forgiveness Program. My name is Lindsay Marks, and I'm a consumer protection attorney in the DC Office of the Attorney General. Our office investigates businesses, including student loan servicers, that engage in deceptive or unfair business practices towards district residents. We frequently work with DSB's Student Loan Ombudsman to help educate district residents on student loan issues. And I'll turn it over to her to introduce herself.
Great. Thanks so much, Lindsay. Hi, everyone. My name is Jessie Myers. I'm the District Student Loan Ombudsman. I'm with the DC Department of Insurance, Securities, and Banking, or otherwise known as DSB. DSB is the district's financial regulator. And so what we do is we help regulate student loan servicers, and as student loan ombudsman, we help educate student loan borrowers on their rights and their responsibilities. And we routinely work with Lindsay and the Office of the Attorney General more broadly to support residents with student loans and emerging issues in this space. So we have a lot to cover today, so I'll dive right in. Today, we're going to be talking about changes to income-driven repayment, or IDR, in public service loan forgiveness, or PSLF. We're going to be covering a lot of acronyms. Generally, we're going to take questions towards the end, but feel free to throw questions that you have in the chat or use the Q&A feature. Generally, try and keep questions more general. If you have a specific circumstance, definitely reach out to us for a one-on-one meeting so we can dive into your specific situation in more detail. Okay, so with that, let's go ahead and get started. So I always like to start with acknowledging that there is a ton of news about student loans. There's a feeling amongst people and borrowers that, okay, I can't keep up. And I want you to know that that's a common feeling. It isn't something that like you're just missing the wrong article or something like that. That's not the case. There's a lot of changes. And so just want to acknowledge that. And it's okay if at the end of this, you're still like, wow, I have questions. You can reach out to our office to have a conversation about your specific circumstances. What we're doing today is providing an overview of the major changes, trying to synthesize what is the most important or might be the most applicable to your circumstances, but it's okay to still have questions at the end of this and definitely reach out to us. So just want to acknowledge that. And I saw someone ask in the chat, would this be sent out? Yeah, they will be posted, the webinars. So this is recording and the slide deck will as well. Okay, so let's start with some key definitions because there's a lot of jargon in this space and a lot of acronyms. So let's break down a little bit some of the language we're going to be using today. Okay, to start, we are talking about federal student loans today. If you're like, okay, I am not sure if I have federal student loans or private student loans, you likely have federal student loans. If you can log into studentaid.gov, you'll see all of your federal loans listed there. Federal student loans are loans made and guaranteed by the U.S. Department of Education. So a lot of correspondence you get will mention Ed somewhere. We'll get into what a servicer is in a second. So you might see like Aidvantage, Mohila, Ed Financial on correspondence. And then, you know, a bit down on the email or the letter, it will mention Department of Education. But generally for borrowers, the way to check, log into studentaid.gov and we'll cover a lot of not tasks, but there's a lot of important programs that you can access by logging into studentaid.gov. So it's important that you can access that website, and that's how you can see all your federal loans. A student loan servicer. So this is the entity that you are probably engaging with most directly. This is probably who you're getting emails from. This is who you're sending your payments to on a monthly basis. This is really your point of contact for your federal student loans. Okay, your principal balance. This is the amount that you borrowed plus any capitalized interest. So this is the foundation for which interest accrues. Whereas accrued interest, this is interest that builds up over time and hasn't yet capitalized. Capitalized is just a term saying, okay, this accrued interest gets added to that balance, and then that becomes your principal balance. So when you hear the term interest accruing on interest, that's capitalized interest. I hope that made sense. Main thing to know is interest accrues on student loans every day. And we covered capitalized interest. But the main thing to know, the reason I start with these definitions, when you log into studentaid.gov, it'll list your balance up top, and then it will list your accrued interest. So that's just kind of what those two terms mean. You can think of it as two buckets, and then when interest capitalizes, like the visual for me is the accrued interest bucket gets put into the balance bucket, and that's capitalized interest. Okay, we covered a little bit of who's who. Borrower, that is you or a dependent potentially, or someone you care about, and you're going to share this information with them. Your servicer, as we mentioned, these are the people, this is the entity that you're interacting with day to day. We included a list of the major federal servicers here. And then the lender for federal student loans is the Department of Education. Okay, so we said today's focus is income-driven repayment and public service loan forgiveness. Why are we talking about this today? Income-driven repayment is a type of repayment plan for federal student loans that ties the amount you pay on a monthly basis to your income. For a lot of folks, this is going to result, well, generally for everyone, it's generally going to result in a lower payment than on a fixed repayment plan. So let's say, maybe you're a student, you haven't graduated yet. You might be put in just an automatic standard plan, and we'll cover the definitions of what these different repayment plans are. But what that's doing is that's going to charge you a monthly amount just based on your balance. The benefit of an income-driven repayment plan is it's tied to your income. So, for example, let's say, you lose your job, you're unemployed. Yes, you could look into unemployment deferment. You could also look into recertifying and reporting your income as $0. And there are types of an IDR plan that would result in a $0 monthly payment. And so this is a really good opportunity for folks who are interested in accessing a lower payment generally. Another big key feature of income-driven repayment is a forgiveness element. After you bid in repayment under an income-driven repayment plan for a set amount of time, typically at 20, 25, and because of a new plan, 30-year increments, you could have the remainder of your balance forgiven. So it not only has the benefit of lowering your monthly payment, but also it has this forgiveness element. So that's why it's important. This is my third key feature. I view this as like under the forgiveness category. Public service loan forgiveness. If you're like, I've never heard that term before, I don't know what that is. We'll get into the details of what this is. Broad strokes, this is a forgiveness program where if you have been working and making payments, 120 monthly payments are about 10 years, while working at a government or a nonprofit, the remainder of your balance is discharged. Why are we talking about this as it relates to income-driven repayment? In order to qualify for public service loan forgiveness, generally those payments need to be under a qualifying income-driven repayment plan. So that's why the changes to IDR are really important. Not only is it the lower payment that we talked about, the forgiveness that's inherent to just making payments under these IDR plans, but also because this is the track you want to be on if you're pursuing public service loan forgiveness. So that's why this conversation is important today. Okay, so let's start with public service loan forgiveness, or PSLF. So what is it? As we discussed, it's a forgiveness program. This is for federal loans. It's administered by the Department of Education. It forgives your student loan balance for those employed by a government or nonprofit entity. So these are the main pillars to know for PSLF. The remainder of your loan balance is forgiven, so that's important. You still have to make payments for the 120 years. So it's the remainder of your balance after you have made 120 monthly payments on a qualifying repayment plan. on direct loans from the Department of Education. So if you're a borrower with Perkins loans or Fell loans, you should talk to us while working at least 30 hours a week at a qualifying employer. So you need to hit all these elements before the remainder of your loan balance is forgiven. Let's focus on this making 120 monthly payments on a qualifying repayment plan piece. What is a qualifying repayment plan? It is all the repayment plans that are listed here. As you can see, almost all of them are income-driven repayment plans. And so it's important that you enroll in these plans and make progress towards payment under these plans. As you can see, the current 10-year standard plan is listed here. One thing to note is that PSLF is a 10-year program. So if you're making payments on that, you have paid off your loans at the 10-year mark. And so in really to leverage the benefits of PSLF, we highly recommend people explore income-driven repayment. And then you have the added the element of lower monthly payments, so it frees up cash flow for you. And in addition, you're also then pursuing IDR forgiveness under the elements of the plan we talked about at the 20, 25, and 30-year mark. There's also some weirdness I just add this so folks are aware. If you have consolidation loans and you're pursuing PSLF, we highly encourage people to enroll in income-driven repayment. There's a lot of issues we see with borrowers in being enrolled in a 10-year standard plan and getting qualifying payments towards PSLF. So I just add that caveat. Generally, what we recommend to folks is enroll in an IDR plan. Okay, so let's talk a little bit more about these different repayment plans. So you can see that this slide is talking about fixed payment plans. There's two major buckets of repayment plans for federal student loans. One is income-driven repayment. The other is fixed repayment plans. Fixed repayment is just a way of describing payments based on just your overall debt balance at a fixed period of time. So let's say you're a borrower who you have your undergrad degree, you got that in 4 years, plus you had a 2-year graduate school program. You'd have a higher debt balance. You'd have a higher monthly payment under a fixed repayment plan because it says, okay, you're paying over a 10-year period. What would your monthly payments look like for this overall debt balance over a 10-year period? So you have the standard repayment, graduated repayment, and extended repayment. Standard is over a 10-year time frame and 10 to 30 years for consolidation loans. Graduated repayments means your payments are lower at first and then increase, usually over like every 2-year period, and are generally over a 10-year span. And then extended repayment, which it can be fixed, which it's a set monthly payment, or graduated, slowly increases to ensure that your loans are paid off over 25 years. Okay, income-driven repayment. So these are the plans that are going to give you potentially a lower monthly payment, have a forgiveness element while you're enrolled in them, and are also qualifying for public service loan forgiveness. So these payments are based on income, family size, and tax filing status. You can see all sorts of symbols next to certain plans. We're going to be talking about changes that we see to repayment plans over the coming 2 years. But generally, these are 4 major income-driven repayment plans that you might be enrolled in currently or might be interested in. So we have income contingent repayment, ICR, income-based repayment, IDR, pay as you earn or pay, and saving on a valuable education plan or SAVE. If you're a borrower in SAVE, you will be required to change repayment plans later this summer. More on this later. If you're a borrower who's in the SAVE forbearance and you're like, what do I do? We'll be addressing that later on. And you cannot enroll in the SAVE plan due to court actions. This is a plan that's no longer available, and borrowers that are in it are under a forbearance currently. ICR, IBR, and pay are all currently available for you to enroll in. The one thing to note is that pay and ICR will no longer be available in July 2028. So, but as you can see, income-based repayment or IBR, there are no upcoming changes to IBR. So if you're a borrower at the end of this presentation, you're like, I just want to enroll in something where I'm set, income-based repayment, or a new plan, the repayment assistance plan, might be your best bet to sort of like set and forget. And generally, too, IBR, all of these plans have different elements to them. For example, how they calculate your monthly payment. ICR is probably going to be the more expensive of the IDR plans. Depending on when you borrowed, IBR might be a good option. Pay might be a good option. We'll go over resources for your specific circumstance, how to cover what the cheapest monthly payment is if your goal is just minimizing your payment month over month. But these are an overview of like the different acronyms that are swirling around in the income-driven repayment world. So in July, a new repayment or new income-driven repayment plan will be available called the Repayment Assistance Plan or RAP. So this will be available on July 1. Here are some of the major features of the plan. So for example, there's a minimum payment amount of $10. That differs from other IDR plans where if your income is zero, as we mentioned, and you report your income as zero, you might have a $0 payment. That's not the case with RAP. With RAP, at a minimum, you're paying $10 month over month. For the sake of time, I'm going to skip over some of the details here. The major thing to know is that payments are calculated as a percentage of your total income using your adjusted gross income. If you have a dependent that takes off $50 a month. One thing I do want to highlight for folks is that there's an interest waiver for RAP. So let's say, for example, that your monthly interest is $80. And let's say under RAP, you're making payments of $30. That $50 that would typically accrue, say on like a standard plan, that will be waived. And so that prevents something called negative amortization, which is like a way of saying interest accruing on interest, which for a lot of folks, like that might be why you're seeing your amounts grow on your account. So that's a benefit to this plan. Another benefit is there's a principal subsidy. So your principal will be reduced up to $50 if your payment doesn't do so. One other thing to flag too is the forgiveness timeline under RAP is 30 years, whereas for other IDR plans, it might be 20 or 25 years. So it's a longer forgiveness timeline. Here's a breakdown of generally what, for certain income ranges, what your repayment assistance plan or RAP monthly payment would be. I want to give a shout out to our partners at NCLC, Student Loan Borrower Assistance. They have a lot of really great resources related to these changes. This table is drawn from there, so I want to highlight a lot of their work. And they have a lot of good overviews of the changes that are going on and as a borrower, things for you to be aware of. But this is an overview of generally what your monthly payment ranges might look like under RAP. We're going to provide some resources at the end of this because like we understand that your IDR plan is something that gets calculated. It's dependent on your family size, your tax filing status, your number of dependents. So there's a calculator online through studentaid.gov where you can plug in all this information and it will spit out the amounts under these different IDR plans. We're also going to highlight a tool from another partner of ours, EdCap. They have a really great calculator that will break down what your monthly payments will look like. I just want to flag that of like, I can understand this is overwhelming. There's a lot of different elements. There are tools available to you that can make this calculation more straightforward. Okay, so that's IDR plans. We talked about the introduction of the repayment assistance plan coming this July, so 3 months. The other thing I want to flag is the introduction of the tiered standard repayment. So for those who are borrowing or consolidating their loans on or after July 1, This is the like fixed repayment plan or the new tiered standard plan. So this is a fixed term for borrowers who will repay with timelines between 10 and 25 years. The main thing to note is that tiered standard is not eligible for public service loan forgiveness. The repayment assistance plan, or RAP, is eligible for public service loan forgiveness. Okay, so that's an overview of all the different acronyms and introductions. Here's another way to break it down by current plan and then the future plans that are being introduced in July 2026. The fixed repayment, the fixed repayment plans, which are monthly payments based on an overall debt balance and a fixed time. Those are in orange. And the payments based on income, tax filing status, and your family size or income-driven repayment are in blue font. I also want to flag too that it's also like IDR, ICR, and pay on the left, and then RAP on the right. Another important thing to note, ICR and pay will be sunsetting after July 1, 2028. So your repayment options are really dependent on whether you are borrowing more or consolidating after July 2026. July 1 of this year is a really key date for what your repayment plans will look like as a student loan borrower. Also, if we have any Parent Plus borrowers on the call, I also want to flag changes there. Our last week's webinar covered changes to the Parent Plus program, so please check out that recorded webinar if you're someone with Parent Plus loans, or in other words, you have loans for your dependent or your child. Okay, so let's say you're someone on this call, you're done borrowing. You are not planning on going back to school. You're not planning on consolidating on or after July 1. You're set. These are the plans that are going to be available to you. So as you can see, the RAP plan will be available starting July 1. You will still have IDR available to you. ICR and pay are available until July 1, 2028. Okay, let's reset. Let's say that you're a borrower. So we have all the plans that we've discussed, all the acronyms listed here. Let's say you're someone that's borrowing on or after July 1, 2026. Let's say you're going to grad school. Maybe you're still in school. Maybe you're planning on borrowing for a dependent. This is what your repayment plans will look like. So the only options available to you if you are borrowing or consolidating on or after July 1 is the tiered standard plan or the RAP plan. These other plans will be unavailable. Okay, I want to show that again. So it's fewer repayment options available to you. If you are wondering what makes sense, we encourage folks to use the calculator available. But as you can see for income-driven repayment, RAP is the only option available. And as such, for public service loan forgiveness is the repayment plan you want to enroll in. Let's go back really quickly to if you're a borrower who's not planning on borrowing more at all. These are the plans that are available to you. So RAP, IDR, ICR, and pay are those eligible for PSLF and under this income-driven repayment umbrella. So to recap, what are the major dates? What are the things to know? So July 1 of this year, RAP becomes available to all borrowers. This is PSLF eligible. Tiered standard is available to borrowers with loans on or after, meaning like you borrow on or after July 1. These are not, the tiered standard plan is not public service loan forgiveness eligible. Any borrowing after this date means only available repayment plans are RAP or the tiered standard plan. If you're a borrower in the SAVE forbearance, I want to note this date as well. On July 1, you're going to start receiving correspondence as a borrower in the SAVE forbearance regarding alternative repayment arrangements. The Department of Education last week announced that they will be giving borrowers a 90-day window from this July 1 date to elect into a new repayment plan. If you're a SAVE borrower, we highly recommend making a new repayment plan selection during this window. If you take no action and you are in the SAVE forbearance, you will be placed into the standard plan, which will be significantly higher monthly payments than if you elect into an income-driven repayment plan. If you're a borrower in the Save forbearance currently, you can wait and you can stay in the forbearance until this time. If you're like, I want to make sure I'm set, you are more than welcome to apply to another income-driven repayment plan, such as income-based repayment, sooner rather than later. But we want to make folks who are currently in the Save forbearance, meaning you haven't been making payments over the past 2 years while in this forbearance, you will be transitioned into the standard plan if no action is taken. So please be aware of these dates. So we highlighted the 90-day mark after July 1, which is September 29th, 2026. But generally, we'll get a better sense of on July 1 what this 90-day timeline looks like. But really in July, folks should start thinking about who are in the Save forbearance, what alternative arrangements might look like. Okay. Thank you for joining me on that journey if you're a Save borrower. Back to general changes. July 1, 2028. ICR and pay become unavailable, so they're sunsetting. So if you're a borrower who's like, for whatever reason, you're in ICR, you're in pay, that's what you're on, you must select another plan. It is TBD, to be determined, on how Ed is handling this transition. So I couldn't tell you at this point with certainty of if it's similar to Save borrowers who will be moved. We're not quite sure. So as we're getting closer to this July 2028 date, you'll likely be receiving communications. And if you have any questions, our office is always available to answer questions. Okay, this is a lot of changes. I want to note that there's a ton of acronyms flying around. The main thing to know most immediately for folks, this is how I recommend distilling it for folks, is to think through this July 1 deadline. What you really want to think through is, okay, what payment plan am I interested in? Use one of the calculators, figure out what makes sense for you. And we're always happy to talk through your specific circumstances, what makes sense. And if you're a Save borrower, that is also, if you're a borrower in the Save forbearance, definitely start thinking about what other income-driven repayment plans you want to enroll in. Okay, so we discussed this, a note for borrowers in Save. The main thing if you're a borrower in the Save forbearance is you should take action within 90 days after July 1 to avoid placement into the standard or tiered standard plan. And I'm not sure we know entirely at this current, on what is it, April 1, 2026, which borrowers will be put into standard or tiered standard. But regardless, the main takeaway is that your payments are going to be higher under that compared to an income-driven repayment plan. So be sure to enroll in income-driven repayment, one of the other plans. A note for Parent Plus borrowers. Again, we had a webinar last week on this topic. The main thing to know is that if you take out any federal loans on or after July 1, all Parent Plus loans, including any Parent Plus loans that you previously consolidated, will be ineligible for income-driven repayment, which means generally you'll be ineligible for public service loan forgiveness. Consolidation has pros and cons, so do research, but it's really important that Parent Plus borrowers, if you're not borrowing on or after July 1, consolidate today. Ed is recommending an April 1 deadline, so please consolidate today. The key is that you want to have the loan dispersed prior to July 1, 2026. If you have questions about this and you're a Parent Plus borrower, please reach out. Okay, resources, because that was a lot and it's so specific to your circumstance of what makes sense moving forward. We talked about calculators. The Department of Education has a calculator. It's studentaid.gov/loan-simulator. It directly draws in your loan balance when you log in, which is really handy. You plug in your information and all those repayment plans it talked about, it will spit out what your estimated monthly payment is under each plan. So highly recommend people use this tool. EdCap our partners in New York who do a lot of great work supporting student loan borrowers. They not only, in addition to NCLC, also have a lot of really great information and articles on these changes, but they also have a calculator that's really handy. So we recommend using both the EdCap calculator and the studentaid.gov loan simulator to get a sense of your options. And if you're seeing really wide differences between those two outputs, please do reach out to us. Okay, I also want to share this table from NASPA that has a good overview of eligibility for PSLF as it relates to different repayment plans. I included the link to this chart on the slide, and then it also highlights that Parent Plus change that we talked about. So this is a nifty resource. This has helped me in distilling some of the changes. The Congressional Research Service also has a handy chart that breaks down, okay, if you're a borrower of loans made before July 1, here's what's available for different repayment plans at certain dates. And for borrowers of loans on or after July 1, 2026, what repayment plans are available for you. Okay, if you're a student loan borrower and you're like, wow, I want to make sure I'm on the track for PSLF. I want to simulate my payments or calculate what they're going to be, and I want to apply to an IDR plan. These are the links to do so. Applying to an IDR plan and certifying your public service loan forgiveness employment, you can do all of that at studentaid.gov. For applying to IDR, it's studentaid.gov/IDR, and for PSLF, it's studentaid.gov/PSLF. And then we have the links for the tools that we discussed earlier. Okay, we're going to end on rights and protections. So as Lindsay mentioned earlier, the Office of the Attorney General and DC Department of Insurance, Securities, and Banking, together we work to ensure and enforce your rights as a borrower in the district. So as a borrower, we want to make you aware you're entitled to timely, accurate, and complete information. You are entitled to accessible and fair customer service, timely and accurate repayment plan processing, correct credit reporting, and accurate repayment plan calculations. So if you have concerns about any of these rights, please do reach out to us. We also help borrowers with complaints about their student loans. So we're happy to chat if you're concerned about anything you're seeing here. Okay, with that, we're going to move into Q&A. And if we don't have an answer to your question, we will let you know and get back to you.
All right. We have a lot of questions, Jesse, about the SAVE plan and whether payments or time in the SAVE forbearance will count towards public service loan forgiveness.
Okay. Okay, I'm going to start with those in the chat. I don't know if there's any cute questions that people submitted. Oh, yes, I see a few. Okay, I'm starting with the chat. Lindsay, I'll just read them out and then answer. And if you want to add on, feel free. Does that sound good?
Okay, sure.
Okay, cool. So someone asked if your IDR was $0 and you're at the 10-year mark for public service loan forgiveness, does the $0 payment still qualify for the 120 payment plan? Yes, it does. So if you are enrolled in income-based repayment and it's a $0 payment, you're still making progress towards PSLF. Okay, someone asked, what about payments under the SAVE plan? Do they count towards PSLF? So payments made prior to the court injunction should show up as qualifying. So if you go to studentaid.gov/PSLF and you certify your employment, you should see green bars on your account. And then if you click, it's like view more loans and loan details. Sorry, it's at the top of my head. I think those are all the things you have to click. And we're happy to help walk you through that. You should see that your payments under SAVE prior to, I guess, June 2024 should show up as a green dot or qualifying. After that, borrowers were in a forbearance. Borrowers can buy back these months under the Public Service Loan Forgiveness Buyback Program. Lindsay, would you be able to throw a link to buyback in the chat? Okay, thank you. A few notes on buyback. So, okay, what is buyback? What does that mean? So that's essentially what is doing is they'll calculate the amount you would have paid under an income-driven repayment plan while in the save forbearance months. And then you as a borrower will have to like pay that check, but you'll get those months back. So you're buying back those months. Um, Lindsay, please jump in if, if that didn't make sense, but I hope that's as straightforward as I can make it. There's some caveats to it. So for example, can only buy back if it gets you to the 120 mark. But for the purposes of this question, which is what about payments under save? So yes, the payments you made under save should count towards PSLF. If they're not showing, please let us know. For months where there were no payments made and you are in save forbearance, you can buy back those months. To just disclaimers isn't the word, but something to be aware of. One, there is a really lengthy backlog in terms of buyback processing with the Department of Ed. I think as of February, like reports from February of this year, Ed processed 2,500 about buyback applications, but then there was a backlog of 80 something thousand, I think 88,000, 86,000 buyback applications. So I want to make people aware that it's a really lengthy processing time. And if you have concerns about that, please do reach out. And two, Ed reported as of last week that they won't be using save amounts to calculate that buyback. So they'll be using other income-driven repayment plans. So it's not what you would have paid under save. It's what you would have paid under IDR, ICR, or pay. I made that more complicated. The point is do payments under save, do they count towards public service loan forgiveness? Prior to the forbearance, yes. For the months of non-payment and forbearance, you can buy back. Okay, so someone asked, on my account, it's paused and my $0 payments. Okay, I think for this borrower reached out to us in terms of the forbearance move. And we can have a discussion of those payments not counting. Okay. For save payments and forbearance months, will PSLF buyback work for these months? Okay, so great question. Yes, with the lengthy delay asterisk. But yeah, generally, and for additional qualifying forbearance and deferment periods, yes, you can submit a buyback request. Someone asked, does being in the save forbearance have an impact on your qualified payments? As in they won't count the months you're on save forbearance towards your 120 payments. Okay, so as I mentioned, as it stands right now, months in the save forbearance, because there are no payments made, do not count towards PSLF, but the buyback program is a way to gain eligibility towards forgiveness for those months. Okay. Sorry, I'm reading through.
Jesse, there's one that says if you are in the save forbearance and you make payments, will those count towards PSLF?
That is a good question. If they're full payments, I believe yes. I'm not sure. Let's get back to that borrower. But I believe if you've made a monthly payment, it's under a qualifying plan and it's in full and you made it on time, I believe the answer would be yes. But I'm not 100%, so that borrower should reach out.
All right, there's another question that asks, what's the difference between ICR and IDR plans?
Oh, that's a really good question. Okay, so I always describe income-driven repayment plans or IDR as an umbrella term. And income contingent repayment is a type of IDR plan. So IDR plan is just like a general term for any plan that ties your monthly payment to your income. So income contingent repayment is one. It's the more expensive of the IDR plans compared to like income-based repayment or pay as you earn. Oh, I actually meant IDR and ICR. Okay, great question. It's so hard with the acronyms and they're also close on the keyboard. So IDR and ICR, ICR generally has a higher payment is the biggest difference. So IDR is generally a more affordable plan for folks. Um, Depending on when you borrowed, the forgiveness timeline may be different of like 20 versus 25 years. Those are the big things to know. But I'm gonna also throw a link in the chat. We were very intentional not to, a lot of presentations will have a table like breaking down the differences of IDR, ICR pay. And so I'll put a link to one of those tables so you can see a better sense of the differences between plans. But it's dependent in part too. There's new IBR and old IBR, depending on if you have loans dispersed before or after a certain date in 2014. But I'll put this in the chat so you can take a look.
All right, Jesse, there's a question about how consolidation affects the timelines for public service loan forgiveness. So I'll just read it. Is it recommended to consolidate loans, for example, from undergrad and grad school for PSLF? And if you consolidate, which PSLF timeline applies? That of the oldest loans or the newest loans? For example,
Okay,
if undergrad loans are at 110 out of 120, but grad loans are at 60 out of 120. How does that change if they get consolidated?
okay, it's a really good question. And consolidation is, it depends. There's pros and cons to consolidating. So here's what happens if you consolidate your loans and you have different PSLF counts. What Ed does is they take a weighted average. So meaning the loans with the highest balance, the the counts of those loans are going to count more. So if you are a lot farther along on a lower, I won't get into the details of it, but they take a weighted average and there's a weighted average calculator on EdCap, which I'll also throw in the chat so that you can plug in your specific loan information. The things to think about with consolidation, there's a few things because there's pros and cons. One is the weighted average element. So like depending on your loan circumstances, that is something to think about. They also take a weighted average of your interest rate. With consolidation, you might pay more over time. So it's really dependent, but it might be worth it for different reasons. It simplifies your payment month over month. It might be worth it to you for different reasons. And like if the weighted average, I'm going to throw in the chat the EdCap calculator. There's a lot of reasons it might make sense for you. And if the interest rate and timeline for payment is something you're not concerned about, then it might be a good option. But I'm going to throw a link in the chat to that covers consolidation so you can get a better sense of like, okay, what do I lose? What do I gain if I choose to consolidate? So for your specific circumstance, we're happy to talk through what your options are and what the impacts of consolidating would be.
All right, here's a question from someone who is having a baby. Congratulations. He has to recertify by May 31st, and the baby is due July 15th. Is there a way to count a future dependent as part of the family?
I'm not sure I know. I
I
think
don't,
no,
I think
but I
no,
don't
but
know.
you can also recertify or like after you have a baby on July 15th
That's a
because your
great idea.
circumstances have changed.
Congratulations. That's exciting.
All right, here's a question about buyback. if an example payment would be 200 a month and you were on forbearance for 16 months, would the total buyback be $3,200?
Yes, that sounds right.
Yeah, so
Sorry,
the
that's
monthly payment times, yeah, the number of
yeah,
months.
that sounds right. Yeah. I also
And
want to flag too, and that's a really good question. If you start getting buyback amounts that you're like, how is this calculated? That's a question like we can ask for calculations. You know what I mean? So like always feel free to reach out to your servicer or reach out to federal student aid to request the calculation for your specific account. If you're facing issues when reaching out to them, reach out to us then to help sort through buyback calculations.
here's a question, I believe, for someone who's in a save forbearance. Would it be better to voluntarily take loans out of the forbearance, so that payments that they make now would count towards PSLF?
Hmm. It's hard to say. It really depends. For some borrowers, like we work with some borrowers who are electing to stay in the forbearance because it frees up their cash for these next few months and that's worth it to them. So it's a trade-off. If you're like, yeah, I'm okay to make payments and I really want to start making progress towards public service loan forgiveness, then I think it would make sense to apply to an income-driven repayment plan. Um, but if it's better, it's really dependent on like you weighing the staying in forbearance and having interest accrue, um, versus applying to an IDR plan, getting your public service loan forgiveness progress. Yeah. Lindsay, do you have anything to add for that?
I would suggest that you do one of the calculators and find out what your payment would be and like decide whether that's something you can do right now and sort of what your risk tolerance for buyback is and if you're very close to PSLF, it, it's definitely a different calculation than someone who has 8 years left.
Yeah, I think that's definitely right.
And feel free to reach out to us if you want to talk through pros and cons. Here's a question about buyback. When applying for buyback, do we have to tell them the amount or will they do the calculation and tell us?
They should do the calculation and set like our understanding for full disclaimer, like I haven't seen a district buyback request yet. So I'm not 100%, I haven't seen the process, but my understanding is that they'll send it a check and so you'll just have an amount to pay.
All right, we have a few minutes left. If you have any questions, you can put them in the chat now. Otherwise, feel free to reach out to Jesse or I at the emails here.
And I want to add, because I know we had a conversation too about, I think it was payments under the forbearance, I think it was, of someone making payments while in the save forbearance. I am not sure about that, of if payments during that time would count or if those would just be considered a voluntary payment on your loan. So if you're a borrower who's in that circumstance, reach out. If you were under save, if you were under another repayment plan, then I think that's a different conversation. Sorry to just revisit that, but I was thinking about it more.
All right, here is a borrower who is close to retirement but still making payments towards PSLF and possibly getting more parent plus loans. What would be the best loan to transition to?
Um,
If they mean repayment plan, maybe.
okay. It depends. I think you should reach out to us. It's really dependent on if you're borrowing for your dependent after July 1. Um, because Any Parent Plus loans after July 1, including a Parent Plus loan that you have now in Consolidate, will not be eligible for income-driven repayment and therefore public service loan forgiveness. So reach out to us would be my best advice. It's really dependent on if you're borrowing after July of this year.
And how much you have currently that would be, and how close you are to getting forgiven.
Yeah, 100%. And debt
Um,
amounts too. I
yeah.
think reach out to us.
Okay, this is a good question. With the backlog on PSLF buyback, would borrowers still need to make monthly payments on IDR while the form is being processed?
That's a good question. I believe yes. But that's another question I'm going to write down and we can follow up on. But yes, I believe the answer is yes.
Oh, and then request a refund. Do you want to speak to that? Or is the Department of Ed offering refunds for individuals who have submitted a buyback and then continue to pay?
So I believe I'm going to throw the buyback link in the chat. I believe they address the refund question on the page. And here I'm going to copy and paste the answer. So this is the guidance that Ed has on the buyback website. So they say you can't receive a refund unless your payment exceeds the amount identified in the buyback agreement. So I'm not sure what this would look like, especially because we haven't seen the buyback process quite yet. Yeah, we can reach back out.
Or if you're in this situation, reach out to us.
Yeah, please do.
All right, here's someone who's wondering about the particular order that they should do things. So, in terms of applying for IDR, getting job certified, and applying for the buyback program.
Um, like, oh, and they're asking for the order to do these in.
Right.
I see. I think because I don't see consolidation listed here. I think you could do, it doesn't quite matter. I always
Well,
lean towards certifying employment
yeah.
first. I don't know, Lindsay.
Yeah, so I guess one thing to note is you can't apply for buyback until you have reached 120 payments. So I don't know if that would apply here, but you have to wait until you would have reached 120 payments to buy back the months. Um, so for IDR, I think if you're in a qualifying PSLF job, or even if you're not, you'd probably want to apply to IDR program first. I'm sorry. They're all they are all save and all separate. Okay. And then I guess we do recommend that you certify your job every year. So if you haven't done that, we recommend that you do that also. Anything to add, Jesse?
No, I agree. I'm looking through the chat to see if there's anything that we missed.
If we didn't get to your question, you can reach Jesse at dcloanhelp@dc.gov, and you can reach me at consumer.protection@dc.gov.
Oh, buyback in school deferment months. I don't know the answer to that at the top of my head. I'm gonna throw the buyback link in the description or in the chat. And I believe on there they have some examples of qualifying deferment or forbearances. I will say that I'm just looking now on the website. This is what Ed currently has if once you can't buy back. So if the loan was in school or in origination, in grace, default bankruptcy, and total and permanent disability or TPD monitoring.
All right. On that, we thank you all for coming. We have one more webinar next Wednesday where we'll be talking about the DC borrower, student loan borrower bill of rights, and other rights that you have in regards to your student loans. All right. Thank you all.
Thanks, everyone.